This week we'll be talking about money markets. In this first lesson, we'll be discussing what is an interest rate, what's the difference between nominal and real interest rates, and how do we track economic activity with statistics like gross domestic product, inflation, and unemployment. So let's get started. When we say fixed income, we are referring to debt securities, corporate bonds, government bonds like U.S. Treasury bonds, money market instruments such as commercial paper, and other securities that pay interest. So fixed income securities got their name because the payments are usually pre-specified or fixed. This is unlike many investments such as a stock where you may or may not get a dividend and most of your return comes from the stock price appreciating or depreciating over time. In fact, the defining characteristic of most fixed income or debt instruments is the stated interest rate that the bond pays. In most cases, individuals would rather consume or spend their money now rather than in the future. When I buy the bonds of a corporation or government, I'm lending them my money. This means that I'm postponing my ability to spend or use my money. Therefore, I will demand some compensation for this. And this compensation is the interest rate on that bond. So here's another way to look at it. There's a concept known as the time value of money. Money you have today is worth more than money you will receive in the future. To be indifferent between receiving money now and receiving it in the future, you have to be compensated for this time. An interest rate represents the price of time. So what determines the interest rate that I will demand in exchange for postponing the use of my money and lending it to you? In other words, how are interest rates set? Interest rates are influenced by economic activity and economic policy. In some countries, the government plays a primary role in determining what happens in the economy, including whether interest rates are high or low. In most market-driven economies, the government plays less of a role, and the markets are allowed to drive the direction of the economy and to influence the level of interest rates. However, even in market economies, both the government and the central bank play a major role in steering the financial markets and the economy. Typically, interest rates react a lot to inflation. If inflation increases, interest rates will go up. Fixed income markets are also tied to government policies like budget deficits, and indebted governments are more likely to issue more debt. One tool that governments use to steer the economy is fiscal policy. Fiscal policy is set and executed by the government, not central banks. For example, the government's objective might be to redistribute wealth by using tax exemptions, or it might want to promote certain sectors of the economy by using targeted investments like spending money on highways and infrastructure. Likewise, the government might want to boost economic activity by using an economic stimulus package. The central bank decisions usually take into account the government's fiscal policy. For example, if a central bank considers that a fiscal policy is too expansionist and likely to generate inflationary pressures, it may increase interest rates to cool down the economy. Most central banks can take separate actions because they've been given legal powers to act independently of the central government. Governments use fiscal policy, but central banks use what's called monetary policy. In the next video, we will talk in greater detail about central banks and how they use monetary policies, such as adjusting short-term interest rates to influence a country's economy. In fact, in market-driven economies, the only interest rate that is unilaterally set by the central bank is a very short-term interest rate in the market where banks partially fund themselves. All other interest rates are typically determined by markets. But for now, let's talk about what indicators central banks and governments use to gauge the health of the economy and how it's doing in relation to those goals. Generally speaking, the better an economy is faring, the higher interest rates will be. One of the primary indicators of a country's economic health is gross domestic product, or GDP. GDP is the total dollar value of all goods and services produced in a country over a specified time period. It's a measure of the size of a country's economy. GDP per capita is equal to GDP divided by the total number of people in the country. Obviously, some countries have much larger populations than others, so GDP per capita can be used to compare different countries. It's used as a basic indicator of a country's standard of living. Usually the condition of the economy is measured by looking at the growth rate in GDP. What economists in the market care about most is called real GDP growth. Real GDP growth eliminates the effect of inflation, or the increase in prices, so it measures the increase in quantity of goods and services produced. Typically, a central bank will assess that number against others to assess whether the economy is in danger of overheating or entering a recession. Fixed income markets will do the same, causing interest rates to fluctuate as these indicators are released. You've probably heard the terms CPI and PPI. CPI is the Consumer Price Index, and PPI is the Producer's Price Index. The Bureau of Labor Statistics directly measures the prices of several hundred consumer goods and services: food and beverages, rent, apparel, gasoline, prescription drugs, and they measure the change in the price of that basket of goods over time. So CPI is basically a measure of consumer or retail inflation. Now, the PPI is the change over time in the selling prices received by the manufacturers and producers of goods and services. So PPI is a measure of wholesale inflation. Of course, inflation expectations have a considerable and almost mechanical impact on fixed income markets. Higher inflation erodes the purchasing power of the future fixed income payments a bond makes. In addition to GDP and GDP growth, one other measure of a country's economic health is the rate of unemployment. The unemployment rate is the percentage of the total labor force that is unemployed but willing to work and actively seeking employment. Now, each country may have its own precise definition of unemployment, particularly when it comes to unemployment benefits, but the International Labor Organization, or ILO, provides a definition that enables us to compare data between countries. A very common way to look at employment data in the U.S. is through the size of non-farm payrolls. So here's a graph of non-farm payrolls in the U.S. for the last 10 years. Non-farm payrolls is the total number of paid U.S. workers employed by any business or government. However, it excludes private household workers such as babysitters and farm workers. Let's take a look at the release of non-farm payrolls numbers for the month of January 2012. Every first Friday of the month, the U.S. Labor Department releases the number of jobs created in the U.S. economy in the previous month. This number has a huge impact on markets because it gives a precise and timely snapshot of how the economy is doing. In this example, the number showed that non-farm job creation was 360,000, well above the estimated number of 160,000. Consequently, the 10-year interest rate jumped up by almost 10 basis points as soon as the number was released. A basis point is 1/100th of a percent, so this is 1/10 of a percent. So now back to interest rates. Interest rates represent the cost of borrowing money. But just like the market cares about real GDP, the market cares about real interest rates. So what are real interest rates? The actual interest rate that companies or governments pay on bonds they issue are called nominal interest rates. Real interest rates are the nominal rates borrowers pay minus the rate of inflation. So real interest rates are important because they measure the actual change in purchasing power over time that comes from saving. In practice, there's another factor that determines interest rates, and this is how creditworthy the borrower is. So nominal interest rates equal real interest rates time value plus inflation plus credit risk premium. Notice I say interest rates. This means that the interest rate that one corporation pays on its bonds is going to be different from the interest rate that another corporation pays and that the government pays on its bonds because the risk of default is different across borrowers. We'll talk more about credit risk in week 2 when we discuss the bond markets. So let's recap what we've just learned. We've learned an interest rate is the cost of money. We've learned about the difference between nominal versus real interest rates. We've learned that interest rates incorporate the time value of money, inflation, and a borrower's credit risk, so that the interest rate that one borrower pays will be different from what another borrower pays. And we've learned about the role of central banks and the major indicators they use to gauge the general health of a country's economy. And we noted that central banks typically use short-term interest rates as their primary tool for implementing monetary policy. In our next lesson, we'll talk even more about the role of central banks and objectives of monetary policy and exchange rates.